Hi everyone, good evening. Welcome to Accounting 203, Introduction to Accounting in this fall 2020. I'd like to welcome you to this exciting world of accounting. This evening, I'm going to talk about the definition of accounting, the definition of a transaction, and the major financial statements. So what actually is accounting? Accounting is the art of recording, classifying, and summarizing transactions in order to prepare financial statements. So it is an art, and some call it an art and science, because accounting has an element of art and an element of science in it. All right, so I'm going to show you my handwritten definition of accounting. I hope you like it. So please read it. You can see accounting is the art of recording, classifying, and summarizing transactions with an aim of preparing financial statements. So the ultimate aim of accounting is to prepare financial statements. Remember, we use transactions as our raw materials, and then the final product, the final output, the finished product of accounting is the financial statements. So if you look at accounting as an information system, then you'll see that its input, the input of accounting is transactions. So that's used as the input, raw materials, and then we process it in the accounting information systems. So AIS is like a factory where we process transactions, and then our final output is financial statements. So consider accounting as an information systems, as like an input-output system where the input is transactions, and it could be just a few transactions or a whole range of like millions of transactions. Large companies they engage in millions and millions of transactions in a particular year. So we can process all these transactions, no matter how many you have and how complex transactions you have. We can process those in a very scientific and reliable way, in a very efficient way, that will produce a set of financial statements that are as little as 2 to 3 pages. Of course, nowadays large companies have like several 100-page annual reports, but that's a different debate altogether, because annual reports are used as communication devices, used to communicate a whole host of other things. But the actual financial statements, except for the notes to financial statement, the basic financial statements are actually quite simple and quite short. And you can imagine that your information systems has to be so efficient that you can process millions, literally millions of transactions in a way that you can produce a small set of financial statements, just a 1-page income statement, a 1-page balance sheet, a half a page equity statement, and maybe 1-page cash flow statement. So remember, accounting is actually an information systems. It is more or less like computer science or MIS. So we call accounting as AIS, Accounting Information Systems, where we process transactions. So transactions are the subject matter of accounting. If we don't have any transactions, we don't have any accounting. No transactions, no accounting. The more transactions you have, the more accounting you need. The more complex transactions you have, the more efficient and smart accountants you need. So that is accounting. Now, what is a transaction? Officially, a transaction is an event that affects your financial condition. So remember, all events are not transactions, but transactions are events. All transactions are events, but not all events are transactions. So that means a subset of events, some events are transactions that qualify for recording in accounting. So what are those events? The ones that affect your financial condition. It has to make a change to your assets or liabilities or equity, or at least it has to change the combination, the composition of your assets. It is possible for a transaction to increase one asset and decrease another. So the total volume of assets could still remain the same where you have already a transaction. So it doesn't necessarily have to increase your assets or decrease your volume of assets. It can just change the composition of your assets. For example, if you buy a computer and pay for it, so you have less cash because you just paid for your computer, and you have more equipment. So your equipment balance has gone up your cash balance has gone down. Or you bought some supplies. You went to Staples and purchased some office supplies. So your supplies balance has gone up, one asset has gone up, and you paid for it, so another asset, which is cash, has gone down. So I made this note as a definition of transaction. You can see a transaction is an event that affects your financial condition. That means a transaction is an economic event. Remember, it is an economic event. So it has to be an economic event. Not all events are transactions, as we already agreed. For example, if the CEO gets married today, and if it doesn't affect the company's financial condition, then it's a big event because our CEO is getting married, or our CEO becoming a father, or our CEO becoming a mother. So these are, of course, or one of my colleagues getting married, or having a baby. So these are important events, or maybe having an unfortunate accident or getting sick. But it is an event, not a transaction, as long as it doesn't affect our financial condition. So these are examples of transactions. You can see: buy a car, pay your rent, buy coffee, sell your house. So these are typical examples of transactions. In today's business, the most frequent transaction is buying and selling. Like Walmart, for them, they have millions of customers purchasing goods, commodities on a daily basis. So you can imagine the hundreds of thousands of scanners scanning the sale of goods. For a bank, for example, there are millions of deposits, millions of withdrawals. So these are all transactions because they affect our financial condition. So we process the job of accounting is to process those transactions. That's why we had to be very meticulous, we have to be very reliable, and we have to be very smart because we have millions of transactions and our users have no time to go through each of those or even a sample of those transactions. They have no time. And our users may not all be in the same location, at the same location where the business is. The complexity of modern businesses, it is virtually impossible for you to physically manage your affairs. So the output of accounting, major financial statements. What are they? You can see, number one is income statement. Number two is stockholders' equity statement, or in some cases we call it a retained earnings statement. So income statement, equity statement, or retained earnings statement, and then the balance sheet, and finally the cash flow statement. So these two, number 1 and 3, these two are the most popular. Cash flow statement is also very popular to investors. On Wall Street, that's probably the most popular of all 4 financial statements. But income statement and balance sheet is the most people are familiar with these 2 statements. Now, what these statements are: the job of income statement is to assess our income. So it assesses how well we are doing. It is a statement of our financial performance. It's also called a statement of financial performance. That means if you look at my income statement, you would know how I'm doing, how much money I'm making, what my revenues are, and what my expenses are. Because an income statement is basically revenues minus expenses. So if your revenues exceed expenses, then you have net income. If your revenues fall short of your expenses, then you have net loss. So it's a profit and loss. In the UK, in old accounting, it used to be called a profit and loss account, P&L account. It's still called P&L account in many places, but it is called income statement in the United States. Number 2 is stockholders' equity statement, where we show the movement of equity. Like at the beginning of a business, say I start a business today with $1,000, so that's my equity. But a week later or a month later, my equity can grow. It could grow or it could shrink. If I make money, if I'm profitable, then my equity will keep increasing, because every dollar profit I make, my equity goes up by $1. And every dollar loss I make, my equity goes down by $1. And every dollar increase in the value of my assets could also increase my equity. And every dollar decrease in the value of my assets could do the opposite. So the purpose of the equity statement is to show the movement of equity, movement in your equity. Your equity means the owner's equity, the stockholder's equity. If it's a small business, then it could be just one person, sole tradership or single ownership. If it's a large corporation, then we have thousands or could even be hundreds of thousands of shareholders. And number 3 was the balance sheet. You can see balance sheet is a statement of all your assets, liabilities, and equity. So it's like an accounting equation. Remember, we talked about accounting equation in other classes, but in this video, we have not talked about the accounting equation. We'll talk about it later. But a balance sheet is actually a depiction of the accounting equation because it has assets on the one hand, which is equal to the total of liabilities and stockholders' equity. It shows all your assets, the current assets, the long-term assets, non-current assets, that is investments, property, plant, and equipment, which is the same as non-current assets, and intangible assets. So 4 categories of assets: current assets, property, plant, and equipment, investments, and intangibles. And then on the other side, it has your liabilities, the current liabilities, long-term liabilities, and then the stockholders' equity. The science of it is that the assets, the total of assets, is equal to the total of liabilities and owners or stockholders' equity. Then the 4th statement is our cash flow statement. Cash flow statement is, as I said, is the most popular to investors, to financial analysts, to those who make predictions, make forecasts about a company's future, the company's earnings per share, the company's stock value, or the company's whole worth. What does the cash flow statement do? Cash flow statement shows your sources and uses of cash. We have 3 sections of a cash flow statement. It shows your cash flow from operating activities, cash flows from investing activities, and cash flows from financing activities. Cash flows include both inflows and outflows. So we have operations like buying and selling goods, hiring people, paying them, having expenses, making revenues, as I said, selling and buying. So that's our operations, paying salaries, paying rent, paying insurance, buying gas, buying coffee. All these are included in our operating cash flow. So it shows the inflows and outflows of cash flow from operations, outflows of cash from operations. And then the investing section, the second section, shows the inflows and outflows of cash for investing purposes, investments in equipment, investments in long-term assets, buildings, land, and even investments in other businesses. So if you acquire a whole business or a big part of a business, that's also an investing activity. So all inflows and outflows of investing type of investing is shown in that segment called cash flows from investing activities. And then the third and final section of the cash flow statement is called the cash flows from financing activities. It shows the money coming in, like cash coming in and going out for financing purposes. So financing means if I need to finance my activities, I raise money by issuing shares, like selling stock, issuing stock, very common in America for large companies, or by selling bonds. A company can also issue bonds. We can also borrow money, issuing notes. So those are our sources of financing cash flow. And then we show the use of financing cash means repayment of loan, paying dividend, buying back our own stock. So if we have too much money that we don't know how to invest in, some companies in America and of course elsewhere in the world, they buy back their shares. So that's also a financing activity. Anyway, so 3 sections of the cash flow statement. Remember, operating section, investing section, and financing section. In the operating section, we show cash inflows and outflows from operating activities, from operations, buying and selling goods and services. Then investing means investing in long-term assets or investing in other businesses. And then financing is raising money, long-term, of course, like issuing stock, as I said, or borrowing, or issuing preferred stock, common stock, and then paying dividend, paying back a loan, buying back stock, and these activities. All right, so these are the 4 financial statements. Once again, income statement, equity statement, balance sheet, and cash flow statement. Income, equity, balance sheet, cash flow. 4 basic financial statements. And it has to be prepared. The first three must be prepared in a particular order. Remember, you cannot do the balance sheet unless you know net income. You cannot do even the equity statement unless you know our net income. So the income statement is the first of the four that you have to prepare. Income statement is prepared first, then we do the equity statement or retained earnings statement, and then we do the balance sheet, or we are in a position to do the balance sheet. And then once all three are done, we can do the cash flow statement. By the way, to do the cash flow statement, we often need not just 1 year financial statements, we need 2 years balance sheets. Income statement for 1 year, like current year income statement, and 2 years of balance sheets, or at least the beginning balance sheet of this year and the ending balance sheet of the year. But that's more details. But remember that these are the 4 financial statements that are the ultimate output of accounting. And the input of accounting, what is the input of accounting? Input of accounting is transactions. So accounting plays with transactions. If we have more transactions, we have more accounting. If we have more complex transactions, we need more smarter, more efficient accounting. All right. I hope that's enough for you to understand what accounting does. And in our next video, we are going to talk about the users of accounting information and people who, basically people who use accounting information and what do they use it for. All right. So I hope you enjoyed it, and welcome to the exciting world of accounting. As I said, I thank you for your patience, and I hope we'll meet you again in the next video. All right. Thank you. Bye-bye.